Hi everyone, I just got to the main screen of Academy City. We're going to go over basic accounting today. I'm going to use a special component that we created here in Academy City. After you log in, you go to courses, and in the business, we have a course that is really designed for someone that wants to study accounting, financial statement analysis, and some corporate valuation in a fast way, still in a high level. So we dedicate about a session or two to each one of those topics. We'll start with accounting today. So I go into here and I go to the first topic. You can see here the topics that we're going to cover in the course, but I will most, since I'm concentrating on the accounting session, I'll just jump right to there. I'm going to the review of financial statements, and this is the special component that we're going to use, okay? What's special about this component? This component introduces all the three financial statements that I'm going to describe. I assume that you really don't know anything in accounting, so, and that's the way I will carry this session. So the first thing is, we're starting by saying we're starting a new business, we're opening a new company, and the company just established. When the company is established, they have nothing, they don't have any resources, and the balance sheet shows me all the resources of the company, we call them assets, and where is that money came from to buy those assets. And the money can come, or I take a loan from the bank, or the investors as the stockholders or the common stockholders invest in the company. Okay, so there's two sources of finance, and with those money, we can invest in assets. So let's start the first one, and I will go into deeper into that one. We just opened a new company. We have nothing in that company, and the first things, we're raising money from the investors of the company. What does that mean? I'm clicking on the first button. Okay, so if you notice, I click that one. That means we established the company and we're issuing equity. What is equity? It's a certificate, it's kind of a certificate showing who is the owner of that company. Here we kind of distributed, let's say everything's here in millions, so we distributed 50 millions, okay, worth of equity, and we raised $50 million. So in the bank account of the company, we have $50 million, and that belongs to the investors that invested in the company. So we can think about it now. We just opened a new company. We registered with the Secretary of State. We got a certificate that we can start businesses. How do we start? We have to raise some money. So the first investors will be whoever established the company, or some friends, or some other investors. It doesn't have to be the entrepreneurs. So they raise some money and they open a bank account in the bank for the company, and they deposited those 50,000 in the bank account of the company. Very, very simple. So for now, we're talking about only balance sheets. Balance sheets reflect again the assets of the company. So far, since the only things we have done, we raised money for the company. We have only cash in the bank account of the company, and the equity shows to whom it belongs to. And here it shows to the common stock. Common stock is the regular stock that usually a company issue when they're raising money. Another way I can raise money is by issuing bonds, or just go to the bank and take a loan. Here I gave an example. I'm raising 600 million in a way of issuing a bonds or taking a loan from the bank. I click on it, and that shows me that, wow, now I have in my bank account $650 million. No surprise, because I raised another 600. Where the money came from? It came from the bank. So if it came from the bank, that's a liability That means it belongs to someone that I took a loan from. So liabilities, it's a source of financing in a way of taking a loan, okay? And that money is in my bank account, in the bank account of the company. So there's two sources, by a loan or by raising money from investors. Together, I have in my hand now 650 in the bank account of the company. And as the company evolved, the next things you start, you're hiring people, you start buying inventory, and you might, if you are a manufacturer, you might take, a raw material and turn them into a finished goods. But we'll take the simple case for now, just to get the idea. Let's take a case that we're buying some goods, we market them, and we sell them to customers. So stage number one, in order to be able to sell something, we need to buy some inventory. So let's say we're going to some suppliers and we buy some inventory and they are willing to give us some credit. In fact, originally they gave me like 90 days or 6 months or something like that as a credit. So I'm buying all my inventory on a credit, on a short-term credit, and how that's going to look like. So I'm clicking on here and it will show me what's really happened. I bought 800 worth of inventory. So I have now the cash and I have the inventory. Since I didn't pay any money, my bank account did not go down. I have in my warehouse now 800 worth of inventory, but I got it as a loan from the supplier. So I got the inventory, but since I got it on a credit, I owe the suppliers. The current liability represent my debt or my credit from the suppliers. That means that the inventory that I got from them, I didn't pay for it yet. So let's sum up the simple case so far. We raised money by way of issuing common stock. We took a loan from the bank and we bought some inventory in a way of credit. So the credit, it allows me to get the inventory and the other money that we raised, it's in my bank account. How much assets this company has now? 1450 million, okay? $1.450 billion, okay? And what is the compositions of these assets? Some of it is in cash and some of it is in inventory. So the total assets reflecting so far it's cash and inventory. In a minute we go and expand it further. What are the resources? Some of which is by way of liabilities and credit, and some of which is the money we raised from the investors. Okay, let's take it one step further. And usually what we do is inventory, we sell it to customers. These transactions a little involved, so I will go over that slowly and I will repeat it a few times. I have a little X here that will be canceling the same transaction. So I will do the transactions, I will cancel and redo it so we'll understand all the effects of selling inventory to customers. And the example I'm going to use is that I sold part of my inventory, part of the 800 to customers, and for that inventory, I charged the customers $12.74. Intentionally, I use some numbers that would be easy to spot for you. Where does it go into those statements? And then it also will give me an opportunity to introduce the income statement, okay? So far, we talked about only balance sheets. It's a balance sheet because it's always balanced between total assets, okay? Total assets, that will be the total. We don't have any long-term assets yet. The total assets, it's always balanced to resources, which is the liabilities and the equity owners of the investors. Now we're going to introduce also the income statements, The income statements come to show how much profit I made during the period. Okay, so I would be selling stuff, so I would get money from the customers. I might sell them some for credit and they would pay me later on, but I usually would sell them for more than I paid for it or more than I bought it for, and then the difference would be my profit. So income statement, it's a statement that shows me the profit for selling goods and doing transactions that make profit for the company. So let's take the first transactions. I click on this button, and then we see a lot of numbers came around. Let's go step by step. Step number one, we see the cash have changed. We had only 650 before. Now it becomes to be 1917. I'm going to explain it in detail in a second. Second things changed, the inventory have changed. It was 800 before, it's only 9 now. Okay, on the other hand, if I look at the right side on the income statements, I get two numbers. One is 1274, it's exactly the number I have written right here, which means I sold to customers inventory that cost me 791, and I sold it to them for 1274. I will repeat. I used to have, let me go back, okay, to remind you, I used to have inventory of 800. Out of the 800, I sold during the year 791. That's why when I click here, okay, oops, sorry, I did it twice, so I should have clicked here. Let me refresh it. I got confused. Okay, could happen. Okay, let's clean the data. I will redo those two, and I will do the third one. That's buying the inventory, and then the fourth one, I'm selling part of the inventory. Again, I had inventory that I bought for credit. Out of the 800, I'm going to sell 791, and I'm going to sell it for 1274. So when I click here, I will see here the amount of money, okay, that I sold it for, and that's how much it cost me. Okay, so the difference will make sense that it's my profit. So the difference between the amount I sold it for to how much it cost me, that's why we call it cost of goods sold, it's the cost of the goods that I sold. So that cost me $791. The difference will be my profit. What happened in the balance sheet? We will expect that this one will be.
I have a question. Hold on.
Sure, go ahead.
You should like write in the case studies like buy inventory credit 800. You should write if it's units or not, because if you're selling, like, I don't know how many units you're selling. It's not really it says how much you made, 1274, but it doesn't say like how many units. So that when I look at the balance sheet, like it's not really like.
See, the balance sheets really don't care, since the balance sheet, the income statement, and the statement of cash flow we'll get later on, they don't really care about the units, how many units I sold. In managerial accounting, you will deal with the units, how many I sold, and for how much I sold every unit. But from financial accounting, what I really care is money. So
Okay.
Here I am really, when I wrote 800, it's not 800 units. In fact, it's 800 million.
800 million.
Exactly.
Okay.
So, but that's a really good question, because
No,
that's really a good
confusing.
emphasis to say
It's confusing because it says
all
cost
of three statements, they are money. They don't really go into detail on, the production itself. That's you have managerial accounting.
Okay, so can you explain why when it was an inventory of 800 and then you press sell for the 1274,
Exactly.
wouldn't there be zero in the inventory though? Because
I didn't sell all of it.
yeah,
So I still have some left in my inventory.
It's not detailed like that. Like I couldn't have figured it out just by looking.
Oh, that's good. So that means if only 791 went to the income statement, that means since I bought 800, 9 have been left in my warehouse. I will
Okay.
sell it probably next year.
Okay.
So this year I still have some inventory I haven't sold. Another thing is we have a new account here. It says account receivables. What does that mean? I sold to customers that inventory for $12.74, but I didn't collect the whole amount. I didn't collect the whole $12.74. 7 million, they are still out there that people will pay me probably next year. So the difference between 12.74 and the 7, it's the cash I collected. So what happened? How did I get the 1917? Let me open Excel for a second and will convince you that that's exactly what it did. We want to understand how much is really my cash account have gone up, okay? And here we will see. We sold the inventory for $12.74, but I didn't really collect the whole amount. $12.74. I didn't collect the whole amount. I didn't collect 7. So therefore, that means that cash came to my bank account, the company bank account. That's the total cash that came to the bank account. How much? $12.67. In other words, I sold for $12.74, but I only collected, this is the amount of cash that I collected. Now, if you remember before this transaction, okay, I had 650. Let's go back a second. Go back in a second. I used to have only 650. Now, how did I came to the new number? When I click here, 1917, I simply take the 650 plus whatever I collected this period. I will add them up together. That will give me the balance 1917, which we just see here. Another word, what is really this amount that I have in my bank account now? It's composed by whatever I raised when I opened the company. 600 came from taking a loan from the bank, 50 came from the equity owners, the investors, and then the amount that I got from the customers when I sold them. How much money I got from the customers? Not the whole amount I sold them, only the difference between the amount I sold them and the amount I gave them as a credit, okay? Therefore, if we look at it, this 1274 appear in the assets, okay, in two places. The cash that I collected, it's added to the cash, and whatever they owe me, they will pay me. So it's still assets. So on the asset side, really went up by 1274. I added the cash that I collected, and I added the amount they owe me. So that will be 1274. Pay attention. On the other hand, my inventory went down by the amount I sold. If you have a good eye, think about it. What really happened? One asset went down by 791, which is the inventory, and another two assets went up together by 1274. One more time, I used to have, this was my balance sheet. I used to have only cash 650 and inventory of 800. What happened now, this one is going up, and this one is going to go up, and this one is going to go down. But the total that goes up, it's exactly my revenue. Those two together will be exactly, the total going up will be exactly the amount of revenue. Some of the revenue I collect is cash, some of that I give a credit, and the inventory is going to go down by the amount that I sold, okay, whatever it cost me. So on one hand, one asset went down by 791, and those two together went up by 1274. Let's do it again. So in another word again, this 1274 represent how much the assets went up by, and this one represent by how much the assets went down. If I see there is a difference, that means I made a profit. This profit has to go to, it belongs to, and it belongs to the equity owners. The equity owners really owns that profit. One more time, the assets went up at this difference because the inventory went down by 791 and those two together went up by 1274. The side of the assets went up by that difference. Therefore, my profit for the equity owners, which is 483, this is going up too. And that's really a reflections what happened in the financial statements when we sell inventory and we make a profit. And we can sum the first rule already, which is really important. The income from the income statements belongs to the equity owners. So this number will always be added to retained earning. What is a retained earning? Retained earning, it's the profit we make, okay? It's the profit we make that we don't distribute as a dividend. That means it's a profit that we keep in the company, and that's one of the sources of growth for the company. Okay, what I'm going to do now, I'm going to do the whole things again, and I want to present the statement of cash flow before I will go into more type of transactions, and I will introduce the statement of cash flow. And that's a good repetition. It's very important in accounting. Repetition is extremely important in order to absorb the real deep understanding how those financial statements work. So let's start all over. And I want to pay attention also to the statement of cash flow. Okay, let me just say that the purpose of the statement of cash flow is one, to present how the cash have gone from zero to this one after those 4 transactions, for example, but we will eventually will see all the other transactions. But the objective of statement of cash flow, which means the bottom line of statement of cash flow, if you see this number, it's exactly 1917. Then we will break it down to 3 segments, and I will go over that in a second. When we go step by step, I will introduce those 3 sections of the statement of cash flow. Very important statement. Another things I can say about statement of cash flow, if you notice, none of those transactions go directly to here, which means every transactions that I would follow next, it's like I typed it in by myself. That's really what it does when I click here. So every transaction is like typing in the balance sheet, in the income statement. The statement of cash flow pull the data from the other 2 statements. In another word, statement of cash flow, it's another way to present the same information that already exists in the statement of income statements and in the balance sheet. That's a good sentence to repeat. Statement of cash flow represent information that already exists in the balance sheet and the income statement. And the reason we prepare this statement, because it's really highlight some important things about what happened in this company. But there is no theoretical addition information. But by the way we present it, that's really highlight some important elements of the business. So let's start all over, okay? So we'll really understand how those 3 statements work together. Let's clean up the whole data. Let's do the first one. We raised money, remember? We clicked the 50, we have a cash, and the money came from the equity. In the income statement, there is no effect. I didn't make any profit, I just raised money. Is there anything did in the statement of cash flow? Well, I see the cash went up from 0 to 50, and I know that this difference goes to go in the bottom of the statement, the change in cash. There's the bottom line in the statement of cash flow. And one thing that statement of cash flow has one section called financing activities. which means I can explain how did the cash went up from 0 to 50 in the company, and the explanation that I get is I simply raised cash by issuing stocks. So what the statement of cash flow is really highlighting that the increase in the cash, it's due to increasing or issuing stocks. It's just the same information being represented as financing activities. I raised money. How did I raise money? By the way of issuing common stock. Let's do the second transaction. I borrowed money. So that's also increased my cash. So the cash went up to 650. The same increase will be again here again. But this time I have two sources. One source was the equity. The second one, if you remember, was the liabilities. Here we go. We present those two sources right here. So the increase in cash from 0 to 650 represented again in a different way that focusing on financing activities. So there is all 0 because I haven't done any other things yet. And only the reason that I have increase in the cash is because of financing. I'm financing the company by taking loan or issuing common stock. That's the objective of the third sections of the statement of cash flow. We'll see the other two in a second. Let's take the third one. We just bought inventory. Let's click on inventory. Well, we have inventory and we took a credit from the supplier. No profit, so income statement has no effect on income statement. Is there any effect on the statement of cash flow? Nothing really changed in the cash because I just bought inventory, but I got a credit, okay? So really nothing really have changed in the cash, so I'm not really seeing any effect on the statement of cash flow. So this is a kind of transaction. When I buy like inventory, okay, it's true my assets went up, but also my credit went up. No effect on cash. So there's no effect on the statement of cash flow. No effect on the income statement because I haven't made any profit. Okay, so this third transaction of just buying inventory reflecting increase in my assets, but also increase in my liabilities. Okay, let's take the next one, which is a little more complicated. Okay, let's click on that one and let's review that one more time. We sold to customers for $12.74. We sold most of our inventory, but we have left with some inventory. And we gave a credit to customers. So we didn't collect the whole amount. We collect most of it, but we gave them some credit. Okay. Is there any effect on the income statement? We already have seen that the difference is our profit. We also seen that this profit shows up in the statement in the balance sheet. Okay, our cash went up from 650 to this amount. Then I have to see it in the statement of cash flow, because in the statement of cash flow, it's always end with the same number. As I have it in the cash, the change in the cash, it must be exactly here. So let's see, how do we get that cash, that amount of cash? Let's look at it. We had a profit of 483. That's a profit. That's increased my cash. Okay. Then in addition, okay, there is something that says increase in working capital. What does that mean? And by the way, when you add this one to this one, it's exactly the amount that I collected as cash from the customers. One more time, if you notice, I have the profit plus the amount I collected as cash. Those together, it's really my cash that I collected from customers. Let me repeat that. If I take this amount plus increase in working capital, in a minute I'm going to explain what is working capital. If I add those two together, it's exactly the amount of cash I collected from
Why
the
does
customer.
it say minus increase in working capital?
The reason is if the working capital goes up, it should be a minus here. If it's decreased, that will be a positive. That's the meaning of the negative
It,
here.
it's a little misleading because it makes me think that
Exactly. It's a
before,
little, when you think about it after that, it makes more sense. But in the beginning, it is really confusing. Some people just call it change in working capital. I like to be more explicit, meaning if it's increase, if the working capital goes up, these numbers should be in a negative. Maybe I should really clarify that.
yeah.
If I have decrease in working capital, this number will be positive.
So
That means
why
my
don't you put
working
a plus
capital
in?
went down by that
Yeah.
amount.
So you should change the plus and the decrease.
Yeah, I can do that. That's the same things. But then when they will see a negative, that might get them confused. So I'm going back and forth on that issue, but you're raising really good point. But by repeating, it's very important to emphasize. If
Yeah.
it's decrease in working capital, it's a positive. So another way is really writing decrease here and don't put a minus here. And if it's an increase, it should be negative. That's another way of writing it, and I really would consider it. It's a good point. But okay, let's see what is working capital. What the definition of working capital? Usually in accounting, okay, the working capital, it's the difference between current assets, okay, to the current liabilities. So you should take 1933 minus 800. That's the working capital, okay? But uh, in for the statement of cash flow, we take the cash out. The cash is not included, okay? So we just take current assets, not including cash. That's, we take that amount, we subtract from it the current liabilities. This is our working capital for the purposes of statement of cash flow. Let me say it. Working capital by accounting standard is current assets minus current liabilities. But for the purpose of statement of cash flow, we subtract from the current assets the cash. So it is current assets not including cash minus current liabilities. So let's see, before we did this transaction, how much was the working capital? The working capital before, it was, I'm not including the cash, so it will be only inventory. That's the only things I have in the current assets. So it will be 800 minus the 800. My working capital was zero before this transaction. So before this transaction, my working capital was zero. How much it is after the transactions? Since nothing changed in the current liabilities, the only things changed is my inventory. So let's do this transaction one more time. Okay, what happened to my current liabilities? Nothing. So my current liabilities is 800. What happened to my inventory? It went down by 791. So the difference now, it's 9 minus 800, it's minus 791, okay? That's my new working capital. So let's do it in Excel again, okay? My working capital at the beginning of the year was zero. Why it was zero? Because it was basically, let's rewrite it in a way of equation, 800 minus the 800. That's what it was in the beginning. I had current inventory was 800 and my liability was 800. The difference is zero. What happened in the end of the year? Meaning for the second year. How much is my inventory now? My inventory now is 9. Okay? How much is my liabilities? My liabilities haven't changed. It's 800. So what is the difference? That's my new working capital. And how do we define working capital? Let's see. What is the difference? I take this one minus this amount. That's how did I get that? That's surprising. Plus that one minus that one. That gives me minus 791, meaning, in fact, that my Working capital went down by 791. So let's look at it up here. Why I'm getting it's that number. Why do I get here why? Oh, hold a second. One more thanks. In a minute, I'll come back to that. We forgot one thing. I looked only on the inventory. That's the effect of the inventory. But pay attention, we had 0 account receivable before. We had 0, now we have 7. So really, if I really want to write this one, let's write it more explicitly. That's for the end of the year. Let's do the whole things. How much current assets we have? We have 9 plus 7. That's the amount of assets we have, not including cash. That's the amount, okay? That's the assets. From that one, I need to subtract, just make sure I'll put this equal sign. From this one, I need to subtract the liabilities, the 800. That's would give me 802. Did I do it right? Let me just double check. Did I have no, I have a minus here. That should be a plus. That's plus that, minus that one. And that's give me 784. Working capital went down by 784. In fact, no surprise, that's exactly the number. If it's a decrease, that would be a positive, and that's really what we have in this case. What does it really mean? I mean, that's technical, but we don't really want to be technical. We want to really get a good understanding of the meaning of this transaction. What really happened when we think about it? On one hand, our current liabilities didn't change, so forget about it. What really happened here on the asset side? Let's leave the cash side by itself. What already happened? We had before, if I go back, I already had 800 of current assets, not including cash. How much do I have now? I already have only 9 plus 7. Let's redo it. I have 9 plus 7. That means my inventory went down. That's really creating kind of a cash, but only to, not by the whole amount of 800. It went down by almost 800, not including those 16. Okay, so that's why we're getting 784. If we had kind of, if you look at it, it's like my current assets went down by 784. So this decline of these assets went into the cash, okay? You can think about it, okay? You can think about it. This 7091 plus, you know, subtract from it the 7, this is really what really gives me the increase in the cash. Or another word, decline in the current assets would go into the cash, and in addition to that, I will add to that the profit. That's exactly what we see here. The profit plus how much the current assets net of the current liabilities, it went down. Okay, I think it's your idea is good. Maybe I will write it plus decrease. That's what makes clear. So the reason I'm creating cash, I'm creating from profit and from reductions from net current assets. Why I call it net? Net in the sense current assets minus current liabilities. It didn't really have any effect current liability because we didn't really have any change on that. So the whole amount of 784 is really in fact from 800 we went down to 16. So that's difference. It's right here. So that one plus that one give me the increase in cash that has to do with that part. In addition to this one, I'm adding the 650. That's why we're ending up with 1970. So in other words, everything that we have done here and here, it just really represented here, so we can really make sense of it. What does it really means? That means from operation, the company have created cash. In fact, the company really took some inventory, sold it, they created cash. They didn't create the full amount because they gave some credit. So the amount that they gave as a credit, I'm not counting for it. That's why we're subtracting the account receivables, okay? The inventory that I didn't sell, I won't really consider it. So I only consider what I sold, and that's credit cash. In addition to what that reduction of my current assets, I have some profit. So you add those two together, this is really how much money I made from operation. That's different than the cash I raised by taking a loan or issuing common stock. One more, so now we can say, what is operation? Operation reflects how much cash I create from doing business and making a profit or reducing my current assets. That's produce cash for the company. Okay? On the other hand, this section shows how I get cash by issuing bonds or issuing equity. Those two sources. Now we have a third segment, which is investment. We'll get to that in a second. Okay? Let's see what is the third one, the fifth one. What happens when we pay the supplier? You know, we have money now. We owe them 800, but we're going to pay them most of it. Okay? We're going to pay them only 768. So what's going to happen logically? My cash will go down, should go down by that amount because I'm paying somebody, and I will owe them less by the same amount. So this transaction, I expect to reduce the cash and also to reduce the liability. So let's go ahead and click that one. And what do we see here? Indeed, this one went down by 768, and really my current liabilities went down by the same amount from 800 to 32. It is the decline by 768. Is there any effect on the income statement? Definitely not. I just paid the debt, okay? Paying the debt didn't create any profit. So there is no effect on the income statement. So transactions of paying debt has no effect on the income statement, only on the balance sheet. Okay? Now remember, we said that what the statement of cash flow ending up in the end, the change, it's exactly how much we change in our bank account. This is went down. Where is that come to? Oh, wow, that's now interesting. Nothing really happened here. So then we don't really count for anything here. Okay, our profit haven't changed. The only things changed is really working capital. Now, after these transactions, my change or my decrease in working capital is only 16. It is not the amount we had before. Let's do it one more time. Many students get confused with that. So let's do it again. What happened after this transaction? Beginning of the year, nothing changed. Okay, we had 800 minus 800. After all those transactions, how much is the assets? How much we have assets now? 9 plus 7. Is that right? So we'll do 9 plus 7. Remember the definition of working capital? 9 plus 7 minus the current liability. In fact, we really have a decline in the current liabilities. This is why working capital, it's decreasing by much less. So I will do minus 32. I will get exactly the amount of 16. Decrease in 16, this is exactly the numbers we get here. Okay? In other words, really, you think about it, I have a decline here in my current assets. Not all of that went to increase my cash. In fact, big part of it went to repay the supplier. That's why my cash didn't go up as much as was before paying the supplier. Okay, so my cash only went up by the difference. Part of this profit or whatever I sold or the money I got from customers went to pay the debt to the suppliers. Good. So now we really see the connections between all those three statements. Let's see the next one. Now we're buying, by the way, can you guess what will happen if I'm just going and buying some equipment? It's a long-term
It would
equipment.
go in
Machinery.
long-term asset, property, plants, and equipment.
Exactly. I will use some cash. Is that right? I need cash
Yeah,
for
you
it.
have to use cash.
If I'm paying for cash, if I'm paying in cash, I'm not taking any
Unless
credit.
it's
So
credit.
my cash will go down. On the other hand, my assets and long-term assets will go up. So let's see that. Let's click it by 400. So really, my cash really did go down by 400. On the same token, my uh, assets went up by 400. That went down by 400, but that went up by 400. Nothing changed in the total assets. Is anything changed here? Nothing changed here. Buying a long-term assets only affect those two accounts. Anything's happening in the income statement? Nothing. I didn't make any profit yet. Okay?
Hold on. So if you write that you're buying a long-term the property, plant, and equipment, but it's under a credit, would you and it wouldn't come out of cash? So how would you deduct it from your
You're
life?
right. You can think about it. Let's say that I didn't pay for the whole amount here. Let's say that I paid only 300, so I would be left with 800. I'm doing it manually, okay?
Yeah.
And I took a loan, short-term liability, I would be 100 here.
Yeah.
That would be a case in which I bought equipment for 400. I paid 300 in cash, and I still owe another 100.
Okay. Gotcha. That makes sense.
Okay, so it will affect now the current liabilities.
Yeah.
Okay, it will affect less the cash, and it will increase. Okay, all right. Let me just go back to our example, so we'll follow the same numbers. But that's excellent question, and this is a good extension. I might even add another example of that kind, which I think it might be useful.
I also wrote a note down. It was a way that Ron Lazar, he taught us to kind of add together our debits and credits so we can organize ourselves so we can put the balance.
Sure, wonderful.
He did it like this. It was like, I don't know if you can see. Try to make
You
it
want me
bigger.
to give you a share? You want to take
No,
the
it's
share?
fine. I just wanted like he basically just listed 1, 2, and 3 like every single transaction, and then he wrote as if it was a credit or a debit, and then like at the
Yeah,
end.
I'm trying to avoid debit and credit. Many students, the word debit and credit get their brain totally
Yeah, I
confused.
know.
If you
I know.
notice, I haven't used that word
Yeah,
even
I have
once.
noticed. I was
I
confused why.
intentionally did it because I don't want people to think. Many times, when you deposit money in the bank, well, it's really a credit. The way you look at it is a credit, but in accounting, it's like debiting the
Yeah,
cash account.
I know
So
how it could be
it's really
confusing.
getting so much confusing. So I'm avoiding altogether the concept. You really don't need that concept altogether. And I think I've seen another one that teaching similar. I was really excited when I saw another person
Really?
that taught exactly like me, and he said, don't use debit and credit, just use assets, liability, and,
Fair
and
enough.
equity. That
Yeah.
makes more sense because I always talk about assets, liabilities, and equity.
No,
So
you're
I
right.
don't really need to use the word debit and credit, but a lot of people, they brainwash you in your accounting class. You break your head in the beginning. It's so confusing.
Yeah, you're right.
Then when you get it
Totally.
and you understand it, then you got stuck with it. And then every time you try to be a normal person, like your brain kind of destroyed in a sense.
No, you're right. I can relate to that. That's what happened to me.
Exactly. So that's why I intentionally didn't use so far the concept of debit and credit, and I don't really want to use it, and I will
Okay.
keep doing that. Okay,
Okay.
so we just bought property, plant, and equipment. We saw there is no effect on the income statement. It did increase it did increase the long-term assets, and it's reduced the cash. So again, the cash went down by the 400. The same amount is the statement of cash flow. So we should see that line somewhere in the statement of cash flow. And that's the third section of a statement of cash flow. If you look at the statement of cash flow, we have a minus 400. Minus represent the fact that as we spend some of the money to increase our investment in a long-term assets. In another word, the middle section of statement of cash flow, if we buy long-term assets, it will show as a negative. Negative is not a negative transaction. It means usage of cash. And that's why our cash went down by 400. Why the cash went down to 700 from 1149? It's because we used some of the cash to buy a long-term asset. And to represent it here, we represent it in the middle section. Okay, so that's reflecting our investment. If we sum up so far what really happened in this company over this year, we still have some more transactions, we're going to them, but what really happened so far? This company created some profit. Okay, we really got some credit from suppliers. That's why we owe them some money. Okay, and some of that we have some assets short term. So we really got a credit of 32, okay? And we hold some of that as an asset, 16. So if you take 32 minus the 16, this is really this 16. It's like kind of the suppliers gave me kind of a loan, and that's helped me to increase my cash. Because he gave me really 32, I sold part of that. I didn't pay him yet the whole amount. I still owe him 32. I already got my money, big part of it, and I still, part of this 32, I keep some inventory and I keep account receivable that people owe me. So the net of those two, 32 minus 16, this is really like creation of cash. So my profit plus this is working capital generations of cash, that's gave me operation cash flow. This is like you can look at it, some people call it like your profit on a cash basis. It's a nice statement, it's a correct statement, but I like the way to say, well, I generated money by making a profit and some adjustment for the fact that I'm getting credit from suppliers. I give credit to customers, as we did here. I keep some inventory, more inventory. So the net is about 16. This number is not really that, not supposed to be that big, okay? So the majority of the number 499, it's really is my net income. We'll come back and we'll talk about depreciation in a second. When we get to that, I'll explain what depreciation is. The second thing is, we really, what did we do with the 499? The 499, we used 400 to buy long-term assets. So we reinvesting part of the cash we're generating. That's a good things about a company that make profits, keep part of it to grow. And that's what gives it the ability the following years to generate even higher revenue, okay? So that's part of the profit that we made, okay, we used to invest in a long-term assets. And in addition to whatever we raised, that's the amount of cash we have in our bank account, okay? So that's really the story of so far what happened in this company. Let's go to the next one. We took a loan. Well, on a loan, we usually pay interest, okay? When I pay interest, what's really happened? The cash will go down, that's it. And it's like evaporating of cash. It's some kind of services I'm getting. So if my assets will go down, that means my equity has to go down. Or in another word, when I click here, I'm paying interest of 130, it's really reducing my profit because my cash went down by 130 and my equity should go down by 130. That's the only things. That's, or in another word, from the gross profit I made, I paid the bank part of it. So the bank took some of the profit, and that's what I had left with, okay? So my cash went down by 130, and my profit is really didn't go up by as much as I thought, 483, it only went up by 353. So here I will see 353, it's going up not by 483 as before, and 130 less. So the cash goes down, and the equity goes down by 130. That's the effect of paying interest. Think about it like somebody came to your bank account and took 130 and it's gone. So that just means that out of your profit that you deposit in your bank account, somebody have taken some part of it. And that's really the reflection of it. So it does have an effect on the balance sheet, and it does have effect on the bottom line of the income statement. And that goes right to here. Okay? What effect in the statement of cash flow? We said if that's went down, it must be here as well. So where is the declining of the profit? It really comes right directly here. We always start this number by the net profit. So if it went down by 130, it will go down also here. So I will have 130 less, and that's explaining why my cash went down by 130. Okay, so we see also the effect of paying interest on the income statement affecting the equity, and it shows as a smaller number in the beginning of the operation sections of the statement of cash flow. Good. Let's take another example. How about if I'm buying?
That last section was a little confusing.
Okay, let's do it again. Let me.
The paying interest of 130.
I took it back, and I'm saying what's going to be the effect of paying interest.
Yeah.
Logically, it's just 130 goes down out of here.
Yeah, sure.
Oh, but if it went here, that means that the equity people has less money.
The retained earnings, yeah, sure.
Exactly. Or in another word, the 130 is like somebody came and took some of my profit.
Yeah. Okay.
Okay. So when I click here, let's do it one more time. I click 130, and then really my cash went down, and that really means my profit. Somebody took some of my profit. Somebody really took some of my profit. So I have less profit, and that's really explaining exactly why my equity went down.
Gotcha.
And the beauty here, we always start with this number in the statement of cash flow, and this decline is exactly explaining why the cash went down, because my net income went down. That's why the 619 went down. Good. The next one is investing in subsidiaries. In fact, investing in subsidiaries, it's just like buying long-term assets. We spent before 400 to buy machinery, plant, equipment, buildings, and all of those stuff. Buying a subsidiary is very similar, just buying an asset. Okay, so we expect to see when we click on investment of 300 in subsidiary that my cash will go down by that amount, and my investment in a long-term assets will go up. I made a special account for subsidiaries, so I expect to see here to go up by 300 and my cash to go down by 300. It shouldn't really have any effect on the income statement, okay? And it shouldn't really have any effect on the side of liabilities or equity. But will it have any effect on the statement of cash flow? For now, we already know. Since it's very similar to the 400 here, I should see those 300 in the middle section.
Net capital expenditure.
Exactly. So net capital expenditure should be minus 700. Let's see if that's right. Let's click on it. And bingo. This one really went down by 400. I have extra 300. Nothing changed in the income statement. Nothing changed in liability and equity. But I have another additional 300 here. That's explained why my cash in the cash account went down by another 300. So investing in long-term assets or investing in subsidiary are similar transactions. Both of them, it's usage of cash. And that's what the beauty about statement of cash flow tells me where my profit went to. Okay, now I can really make the story a little more interesting. My profit was only 369, but I'm invested 700. So that means I used part of the money that I raised by way of taking a loan or raising by investors. Or the source of money, it's what the investors gave me. Investors mean all the debt holders or the equity holders, they gave me 650. I made profit of 369. I use those, part of those together to invest 700. The net, it's left in the bank account. Or in other words, this is a source of cash. This is supposed to be a source of cash, and that's usage to invest in the company, in the assets of the company. And that's the natural things that happen in the company that start business, they're increasing their assets, they're increasing the amount of machineries, buildings, etc. And we will start seeing more investment in these sections. This is really mostly for operation. So we don't, most of the businesses, this number not supposed to be that high unless it's a real estate company or utilities that have a lot of inventory, maybe, refineries or whatever. But most of the businesses, really, this is really should be the majority part of really running the business I need. I'm investing in subsidiaries, I'm investing in machineries. This is the core asset of the long term. And it's come to a place, how much I invest this period, it's come up in this section. Let's see the next one. It's invest in intangibles. It's really is just like buying another asset. This time it's not fiscal assets, but it's intangibles. Well, I can't really see it, but for example, let's say I bought a patent from somebody. So my operation will benefit in the future. I can't really see it, but I have a paper. I have the know-how. I know how to build better stuff that I'm manufacturing. Let's say if I'm a car manufacturer, then if I buy a patent how to manufacture my engines in a better way, that should be reflected in the future. But the investment itself, it just like should reduce my cash and increase my long-term assets. That's why we have here intangibles in the long-term assets, and this is going to reduce my cash further by the amount of 120. Let's click on it. Yes, my cash went down 199 and my assets went up by 120. That's the effect only on these two accounts. No effect on the income statement, no effect on liability of equity. And that effect also shows again additional. We had 700 before, now we have 820, makes sense. We
What's the
invested more
1,035?
money into additional assets.
What's the 1,035 below long-term
Which
long-term
one?
assets? It says 1,035 below long-term assets.
I can't hear you. One more time.
It says 1,035 below long-term assets, below 8.
This one, okay. This one, in fact, it's the sum of the current assets plus the long-term asset. So
Okay.
820, it's the sum of the long-term assets. I should really write it up, total assets.
Yeah, you should. Yeah.
I should add here total assets. That's what it is. It's the long-term assets plus short-term assets. Okay,
You
I
should
just
do
didn't
that
want to
for
make it
all. You should do that
crowded.
for all sections. You should do total current asset, total long-term asset, total
Right. I
liability.
probably will add it to here, total current assets, and here I'll put total long-term assets and below that total assets. But
Yeah.
thank you for the question. That's a good one. Okay. So, and that always will be equal to the total. By the way, what is this number? This one is really the total of liabilities plus equity. So liabilities plus equity will always be equal to the total assets. That's why 1035 equal to 1035. They're always balanced. That's why it's called balance sheet. It's always balanced. The assets always equal to liabilities and equity. If it's not, it means that you made some mistake. Let's move on to the next one. How about if we spend money on marketing? I mean, customers need to know that we are in business. So we spend money on marketing. What does that mean? It means that my bank account would go down immediately. Is an asset created? Most likely yes, but in accounting we usually don't show it. So we just show that some money have been spent. That means part of the profit went for marketing, which help us to generate the revenue. So if I click on here for 110, I expect my cash to go down by 110. And indeed it did, from 199 to 89. And this is really a reductions in the equity. But again, the reductions in the equity return earning, it is really a reduction in the net income, meaning part of the gross profit, okay, I paid the interest before, if you recall, and I also paid some expense into the marketing part, so I can really generate some revenue. So expenses reducing my profit, my gross profit. One, it's by spending on marketing. Before we saw we had to pay the bank interest. Those two reducing my gross profit to be lower, the net profit would be lower. And what would go to the equity would be lower by 110 here, which reduced the cash. So these transactions of sales and marketing expense of 110 reduced our cash, and in the way of reducing our profit, and reducing our profit, in another word, it's reduced the equity. So reductions in cash, reduction in equity. Is there any effect? Is there any effect on the statement of cash flow? Definitely. We always know that it always starts with the net income. So the 110 decline here, it is really declining net income, and therefore we have less cash. The cash of went down by 110 is also reflected in the statement of cash flow by having a lower net income. Lower net income by 110 would reduce eventually my cash in the calculation by 110. And that's really linking those three statements together. What is the next one? Another expense, I spend on marketing, I spend salaries to employees, managers, all of those are expenses. So this is really a similar transactions, just this one was for marketing, this one is really for administrative purposes. I pay rent, I pay employees, I pay managers, all of those are expenses. So that's going to further reduce my profit even further. So if I had a profit of 243, I'm expecting it to go down by 75. So my cash will go down probably by 75. My return earning will go down by 75. Why? Because here I will account for the spending of administrative expenses. And usually we put it in a special line, says general and administrative expenses. So I expect this one to be minus 75. So let's do it. I click on it. Indeed, my cash went down by 75. My expense here by another 75. If I have my expense went up by 75, that my profit will go down by 75. My profit going down by 75, that means my return earning will go down by 75. Now, wow, now we really have a real company almost done with almost everything, okay? We indeed, our cash is only 14, and we spend some money, so our profit, it's lower. So our profit now is only 168, okay? Some of, we reduced the working capital. So the cash that generated from operations was only 184. We used a lot of money for long-term assets. What is the long-term assets? Just to remind you, long-term assets, property, plant, and equipment. We invested in subsidiaries. We invested in intangibles like a patent. So we used a lot of the money, but the profit wasn't enough. We had to use some of the money we raised in a way of taking a loan and in a way of issuing stock. The money we raised here plus the profit we made allow us to invest of 820, and whatever left, it is cash in the company. Very little, most of the profit and whatever we raised, we used to buy long-term assets. So this is really the nice things about the statement of cash flow. It always shows you the sources, the first one and the last one, and how did you use it for a long-term asset. One more, last one, I wrote here investment in commercial paper. Sometimes when you have cash, say 14 million doesn't look a lot, but you don't just leave 14 million in your bank account and don't utilize it. Many times companies, what they do, they take some of this cash and invest commercial paper. Why commercial paper? if you believe that those ones going to go up, or many times they're paying you very similar to interest, you might even buy just government bonds or something like that, so you get some interest on it. So that's why people invest in commercial paper. So it's another way. It's really taking some of the cash and investing it in another asset. So we'll expect after investing in commercial paper that our cash will go down and our current assets will go up. But there are
Why doesn't
commercial
it say
paper that
how
are
much
good. If
you're
I need
investing?
cash, I always can return them into cash immediately. So that's keep me liquid in the company. So
Why
let's
doesn't it
click
say
on,
how much you're investing in the commercial paper?
yeah, I
Are
didn't
you,
write here. I need to write the amount. So when
are
I
you just
click, I will see
assuming
the
it's the rest
exact
of the?
amount.
Oh, okay.
Yeah, I
So yeah.
should write 6 here, as I did in all the other places. This should say 6 here. That means I invested 6. That means from 14, I went down to 8.
Yeah.
Again, my cash went down. Did it affect anything in the income statement? No. Did it affect anything here? No. It's only we replace one asset by another one. So is there any effect here? Definitely yes. My working capital, it's different. It's only by 10. And that's the only effect that we have here. It's went down from 16 to 10. That's the only effect. So the decrease in our working capital now, it's only 10. Because if you look at that, we have 32 minus 16 plus 6, that's 22. That's exactly give me 10. 32, and the sum of those 22, they give me exactly the 10 by the definition. Okay, good. Last, and that's really conclude, we account for depreciation. What is depreciation? You know, we bought assets for 100 and we utilize those machines, and those machines most likely will be worth less by the end of the year because some of them have a wear and tear and we'll have to replace them eventually. But for now, okay, we don't really spend any cash, but we want from accounting point of view to be more realistic that not the whole 168 is really a profit, because part of my profit really should be used in the future to replace the wear and tear of the equipment, property, and planes. So I'm accounting for the fact that part of my property, plant, and equipment is being used and their value went down, I account for it. So what will happen if when I account and I say my depreciation was about 10% of the 400 and I counted for, what does it really mean? That means that really the net value of my investment for 400 went down by 40. It means that I have another expense here that part of my profit, okay, I should really keep. I should really keep part of my profit in the future. So from income point of view, I'm not really using, I really did increase by 168, but when I look at my profit, I'm saying to myself, make sure, Amos, you really didn't make the 168 because eventually you will have to spend those 40. Okay, so keep in mind that your profit is really only 128. From cash point of view, this is very interesting. That's probably one of the little hard for, and that's sometimes you don't see it, but I broke it down intentionally here. I added depreciation back here. If you see the 40 here,
Yeah.
the fact that we took depreciation did not change the cash. If it didn't change the cash, which makes sense, it's just an accounting. It's like I took the 40 down here and I reduced the profit by 40. One more time, let's do it again. Let me repeat that one. Okay? See, my profit was 168. That's 1/68. So when I'm doing the depreciation, I really lining like the asset goes down by 40. Going down here, it means the profit went down, but it has no effect on the cash. So eventually, I should not really have any effect on the bottom line on the cash. And let's look at it one more time. I'm going to do it again. Okay. Notice here I have 168 and here I have 820. Okay. This is really all our long-term investment. When I click on the depreciation, pay attention. It's like I added 40 here back and I'm adding the 40 here because it used to be 820 here. Is that right? The reason it went down to 780 because now my long-term assets went down by 40, which is the depreciation. At the same time, my profit went down by 40. So what I'm really doing in the statement of cash flow, the bottom line is not going to change, but I'm adding back the profit here because on a cash basis, I did collect 168. Okay? At the same time, the value, I didn't really spend any money or I didn't get back, I didn't sell any equipment. Okay? So although on the accounting point of view, I see here 780, the truth of the matter, I didn't spend the 40. So what I'm doing, it's a technical corrections. I'm adding back the 40. It's like canceling the depreciation transactions. I put back the 40 here. Sorry, I put it back the 40 here, and I put it back the 40 here. So that's back to 820, and that back to 168. Okay, one more time. Let me go back. Before that, that's the situation was before the accounting for the depreciation. There's no depreciation. When I click on depreciation, stage number one, it shows in the income statement. So my income went down to 128. That means the
Almost
equity
it's
went down.
confusing also because when you before you press depreciation of 40, the net income on the statement of cash flow was 168, and then when you press the depreciation, it says plus the depreciation, which is 40, and it
Yeah,
actually
let's
goes
do it
down.
again. Let's do it again. Let me go back. I have 168. You see
Yeah,
that? Okay. And that's exactly the same number as I have here.
yeah.
Okay, but what happened when I click on this one?
The depreciation says
That
it's
went down to 128
yeah.
because it went down by 40. So I
Oh
said,
wait,
no, 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 no. This is just accounting things because
yeah,
no money really have touched the bank account. So I'm
yeah,
adding it back. That's why the depreciation in the statement of cash flow should be put back. The
yeah.
same
Okay.
thing is about the assets. Nothing really changed here. I'm using the same machinery. No cash have been changed. So although I'm accounting here minus 40, I'm adding it back here to the minus 40. So in the statement of cash flow, you can think about it. The effect is putting back the depreciation and putting back the depreciation here in those two places. The net effect is zero. So depreciation has no effect on the statement of cash flow. Simply, nothing really changed in the bank account. It's just the accountant says, oh, let's reduce the profit by 40 because we have to realize that the 168, not all of it was profit. Eventually, we will have to use that cash. But for now, we have that cash. But just to reflect what is called accrual method, meaning I am accounting for the fact that one day I will have to spend that money, okay? The value of my asset went down, I should really account for it. Okay, so I'm reducing the value of my assets, meaning I have less in my equity as well, okay? But no cash have changed. So in the statement of cash flow, I reversed it. And here I have 40 back and I have 40 back here. Let's conclude really the relationship between those three statements of building up a company from scratch. In the end of the year, in the end of the first year, this is the way the balance sheet looks like. This is the income statement, and this is the statement of cash flow. Now we will conclude this session by saying, okay, let's say the company is starting a new year. We're not going to go over all those transactions, okay? I will show you what the statements looks like for the following year. So if you go and you refresh the screen, just go back to the same place. Okay. In fact, if you notice, if you had a good eye, I just put whatever we did, all the stuff we have done before as belongs to the previous year. We are in the second year of the cycle of the company. And now I'm not going to go over all those transactions. Usually you are as an analyst, you're not going to be exposed to all of those, just to have a good understanding. That's why we're going over all of them. Eventually you're going to get financial statements that look just like the one in front of us. We have balance sheets at the beginning of the year, balance sheets in the end of the year, meaning we moved from here to here, and we have the income statement for the second year. And then from the information here, we have the statement of cash flow. That's really the way it usually you'll see it in real life. You'll have beginning balance sheet, beginning of the year, which is the end of last year. You'll have the balance sheets for this year, end of this year. You'll have the statement you have the income statement of this year, and then you have the statement of cash flow, which is really derived from those two. Let's look at it, okay? The first thing is a change. We have a change of 10. Where is that 10 came from? That's exactly the difference. This year, our cash went up. We did some operations. We did some stuff. The cash went up. Sometimes the inventory went up. Maybe we bought some more inventory. That's really what it means. Probably I bought a lot of inventory. If I were to ask you, how much inventory did we buy this year? You should be able to answer that. Why? Because what really happened here? We increased the inventory by 2, and we sold a lot of inventory of 1610. So if I take the 2 and I add to what I sold, that's the amount of inventory I've acquired. Let's do it again in Excel. That would be nice. So how much really inventory did I buy this year? It's the increase by 2 plus whatever I sold. So that will be 1610 plus 2. 2 is the difference between 9 to 11. That's the amount of how much, that's the purchases. So if somebody asks you, what is the purchases of this company this year? It's 1612. Okay, that's clear because we really understand now what happened. This year, again, the depreciation, we have 40. That's why in the statement of cash flow, we see 40 here, we see 40 here. How did I get 35 here? That's again, very simple. I just see the difference. I will see the difference between the total net after I subtract the depreciation, the total net went up by 35. It went up. It means I used part of the cash to raise my net long-term asset. That's the 35 right here. So every number here is very clear. I increased my assets by 35, but just remember, if my net assets went up by 35, that means that I spent more money because I had to cover the depreciation. So how much money went out of my pocket? It's 75. Okay, some more. My net income was 112. Now it's not surprising. I see the 112 is coming right from here. The 112, by the way, where do I see it here? Where do I see it here?
It's in retained earning.
Exactly right. So in my retained earning, okay, I have 112. Okay. By the way, I think there is an error here. Yeah, I just spotted it. In fact, this one should be adding to this one. So this number should really be here. I should add them together. So that's what give me a 0. That give me 34. That should be 240. That's really what it should be. I will fix it. That should be 240 because I have to take the net income. I'm adding the net income. Let me take it back. Sorry, my mistake. This is correct. There's no error.
Okay.
This is okay. This is my mistake because there's one more element that I haven't talked about yet, and it's introduced in this example. The 112 is correct number. We expected really, if according to what we learned before, the retained earning, let's calculate the retained earning. We had the beginning of the year 128. We had a profit this year of 112. So the retained earning should have been that amount. But I see that my retained earning is not 240. It's only 112. What is the difference? That's when the company distribute dividend, the money goes out. I mean, my bank account would go down. It's like giving back some of the money that I raised originally from investors. It's like reverse of raising money from investors. When I raise money from investors, investors put money in the bank account of the company. When I pay them dividend, it's exactly the inverse transactions. So I need to really look, if you look at the dividend in the statement of cash flow, it's 128. That means my equity should go down by 128, and that's what give me back to the right amount in retained earning. Sorry. I do it again. One more time. Plus 240 and minus the 128. That gives me that in fact I have left with 112. One more time. What explains the difference between the retained earning? To the retained earning, I need to add the profit. I'm adding the profit, and after I add the profit, I have to subtract the dividend. That gives me the retained earning for the second year. Something we didn't have in the first year, we didn't pay any dividend. I probably should have add another case study for dividend already for the first year, and that's
We
what
should also add a case study. I noticed you didn't talk about LIFO or FIFO, any of those kind of key concepts.
That's more detail. That's more detail on how you account for inventory. Usually in real life, you can even prove it that in the long run, when you have many years, they will end up to be the same effect on cash flow. It won't have any effect. Okay? It's only accounting, but it's a good point. But it's really more into managerial accounting on how to account for that. From financial accounting, it's just really whatever the inventory is.
Got it. Okay, that makes sense. So the school teaches it more of a managerial accounting way, I guess.
Correct. This one is financial accounting, which is really the most important for managers. Managerial accounting is really very important if you work in the operational part. You really have to know that very well. Secondly, if you know managerial accounting, you don't really have a lot of rules on how to do it. And you can be very creative, and there is no one way that is the right way. So you can use FIFO, I can use LIFO, and both of them will be fine. And both of them have some effect, especially in the first year or two. After a while, the same effect on the statement of cash flow will be almost zero. So, but it's a good point. We can really expand, but I think dividend definitely has to be added for the first year.
Yeah, definitely.
And I would consider maybe even combine some.
You should also throw, like, I don't know, I don't want to mess with your thing, but it seemed like the whole year the company made one large sale at the beginning of the year, and then they kind of lost all of their funds after
You're absolutely right. I should probably say that this is the total what happened over the year.
Yeah, you should also I don't know.
Because otherwise, we will have a lot of clicking here, and I don't want to do too many. So, but the truth of the matter is, you're absolutely right. When I click on sell, like transaction number 4, this is really many sales over the whole year.
Oh, okay. So it's not just at a time. Okay,
exactly. So I just meant it. It's like one. What happened over the whole year? That was the sale over the whole.
Okay. Fair enough.
It's the same. You can think about it. The same things with the supplier. When I buy from the supplier, I don't really just buy once. Maybe I buy 4 or 5 times over the year. So I just add them up together for the whole year, just to simplify the concept.
Okay.
That's really concluding a real good understanding of the 3 major financial statements. The next stage is to analyze what really happened over the year. We touched that a little bit. The next topic is supposed to be, before we get to ratio analysis, it's what known vertical and horizontal analysis. What does that mean? It's
From a graph.
analyzing growth rate of the revenue, growth rate in total assets, and all of that. That's horizontal. And vertically is really how much is really my profit, gross profit as percentage of the revenue this year relative to last year. And all of those, it's the next topic we will handle. Now that we really understand what those statements are. And after the vertical and horizontal analysis, we will talk about ratio analysis. And that will give us another tool of analysis. Pay attention. So far, we touched basically accounting. Now we're moving a little bit into the analysis part of it, okay? And then we get into valuation. That will be the last part of the course. Thank you, everyone. Thank you.
Very nice. I liked it.
Great.
Yeah, I definitely learned. Yeah, I learned way more here in an hour and a half than I learned in